Hello and welcome to Cheppy Today. I'm Will, and today we're going to be looking at two very different sides of the same coin, and that is the bullish versus the bearish case for Bitcoin. Strap in. So it's fair to say these two very different opinions don't often get looked at side by side, meaning that quite often there's an inherent bias when these cases are put forward. So for this, I'm going to put my preconceived notions aside and try and be as impartial as possible. No. Okay, so let's kick this right off with the bull's perspective. So first up, Bitcoin's fundamentals have gone from strength to strength, especially in sight of newly emerging Layer 2 tech, which is fostering growth outside of Bitcoin's restrictive blockchain. Protocols such as the Lightning Network are working towards scaling Bitcoin and slowly eliminating one of the bear's biggest arguments. Lightning has grown massively within the past year, now citing more than 3,160 nodes with active channels and a total capacity of 660 BTC, an equivalent of just under $2.4 million. It's been noted that Lightning will enable BTC to process millions of transactions per second, making it the fastest payment network in the world. The Lightning Network is now reaching critical mass, thanks in part to prominent propagators of the tech. Recently, Jack Dorsey, CEO of Twitter and financial services company Square, confirmed the integration of Lightning on Square's mobile-based Cash app. On top of this, acknowledgement of the Lightning Network is increasing, especially with the new social media initiative of passing the Lightning Torch, in which users demonstrate the protocol's prowess, and apparently community trust by sending Lightning payments between users. Recipients then add 10,000 Satoshis each and pass it on to the next user. This not only tests the network's capability of processing low-level payments, but also spreads the good word. The latest recipients include the aforementioned Mr. Jack Dorsey and the CEO of Binance, CZ, who's currently trying to pass the torch to Elon Musk. Good luck, CZ. So as far as the bull case for Bitcoin goes, the ability to transmit millions of transactions per second must be worth something to someone, right? Not to mention, Bitcoin holds the accolade of best performing asset in the last 10 years, outdoing legacy stocks such as the S&P 500 and treasury bonds. And even though it's at a discount of around 80%, BTC still cites an increase of over 250% in 2 years. A monumental rise, especially when compared to its contemporary counterpart gold, which cites a mere 1.2% increase in the same time. Pathetic. Now, a thought of an 80% reduction is pretty scary, and in a bear's perspective, it is indicative of BTC failing. However, not in the bull's perspective, because this has happened many times before. 4 times to be exact. Nicely laid out here by Twitter user Rect Capital. What an appropriate name. One of the first cycles was noted back in 2011 to 2012 of the 48-week-long bull market, followed by a 22-week bear market, and a reduction of 93%. Bitcoin grows with every cycle, consolidating further gains with every bubble burst. So while people complain about reduction, it's actually a gain overall. Moreover, these cycles have actually been deemed a good thing, forcing weaker hands to capitulate and a focus on fundamental development without the distraction of price hype. With this in mind, it's understandable that Wall Street are becoming increasingly interested, which brings us nicely to our next bull case. Institutional money. It's been noted for some time that the entry of institutional money is imminent, waiting on the sidelines, and some even trickling in through over-the-counter trades. In fact, the aforementioned Square is one of those companies leading BTC adoption. However, we're not likely to see the real effects of this new money until upcoming launches from Bakkt, which is said to be launching at the end of 2019, as well as Fidelity's custody solution, which could launch as soon as March. 2 ventures geared at securing further institutional investment. It's thought that this institutional momentum may even win over Jamie Dimon, a notable Bitcoin bear, and CEO of banking monolith JP Morgan. Rumors are circulating that JP Morgan may even look to hold a position in crypto, as soon as Fidelity and Bakkt prove there's a demand for it. Another slightly more divisive avenue for institutional investment may be the notion of a Bitcoin ETF. I'm in bull mode, so I'm going to steamroll straight to the positives. Back in 2003, the first gold-linked ETF launched, and with it, the price of the precious metal skyrocketed, from $330 to $1,300, thanks to market exposure. Many cite this rise as an argument for a BTC ETF. Furthermore, BTC being backed by a listed and regulated exchange will further legitimacy massively. Now for the bear's case. So let's kick this argument off by addressing the elephant in the room. It was noted just a few weeks ago that we had entered the longest bear market in crypto history, continuing on a steady decline since the highs of 2017. Putting it in perspective, this is over 60 weeks of crypto winter, with many bears predicting that BTC has further to go. A recent report by Dare hasn't done much to quell these thoughts, as data compiled from multiple exchanges shows Bitcoin's trading activity at lows not seen in years. One of the world's largest and most popular exchanges, Binance, saw trading volume drop by 40% in January as compared to the previous month. Similarly, Coinbase is also exhibiting signs of trader apathy, with the exchange processing processing just $1 billion of BTC UTC trades, a massive reduction from the start of 2018 when it processed over $8 billion. Interestingly, Bitcoin futures appear to have taken a similar downward turn, with volume dropping off at the latter end of 2018, increasing somewhat in November only to plummet again a month later. This decline is Nouriel Roubini's idea of a wet dream. Roubini, aka Dr. Doom, an impossibly harsh critic of Bitcoin, believes that rather than BTC becoming a reserve currency, or a quasi-gold standard as the bulls would have you think, it is much more likely that rather than bowing to the whims of an uncontrollable decentralized currency, the governments of the world would simply issue their own, in the form of central bank digital currencies, or CBDCs. Roubini, a professor of economics, argues that a move to CBDCs would kill two birds with one stone, replacing the crisis-prone banking system while simultaneously shutting out cryptocurrencies. Interestingly, a survey from the Bank of International Settlements explored the lengths to which central banks are looking into these forms of controlled digital currencies, returning the result that approximately 70% of central banks are looking to implement CBDCs. While the survey caveats that these wouldn't be issued anytime soon, this still doesn't bode well for propagators of BTC as a reserve currency. Furthermore, governments will undoubtedly be reluctant to relinquish their control over fiat, or their ability to impose taxes anytime soon. Now, although the notion of an ETF has already been glossed over in the bull's argument, it's equally as relevant in the bear's case. For any ETF to be approved, BTC needs to be regulated, or at the very least it needs to prove that it cannot be manipulated. And although efforts in self-regulation is on the increase, crypto is still a fairly wild place. Since the start of 2019 alone, we've had two potential exit scams, one in the form of the Cryptopia exchange hack, and of course the Quadriga incident. While these don't necessarily pertain to Bitcoin itself, it still isn't the best look for the industry moving forward. Now, I said I was going to be impartial, but it. When it comes to seeing both sides of an argument, I don't typically have too much trouble. However, scouring for reasons to be bearish was genuinely difficult. For the most part, these bearish arguments fail to hold much merit. Currently, Bitcoin price action is a shadow of its former self being a brief stint at $20,000. That means literally nothing. That was built entirely on speculation, not fundamentals. However, since then, Bitcoin and the wider crypto industry has grown and evolved immensely, especially on the developmental side. On top of this, institutions with billions are eyeing up BTC, and some are even backing it. The best part to all this is that Bitcoin is only 10 years in its infancy. These are extremely early days. However, my opinion won't change anything. There's only one way to settle this. But as always, we'd love to hear your take. Let us know whether you side with the bulls or the bears on this one. What would be your bull argument for BTC and what would be your bear argument? So leave a comment, leave a like, subscribe, and we'll see you next time.